Imagine two friends. Both start with $10,000. One becomes a trader, spending hours analyzing charts daily, making dozens of trades weekly, feeling the rush of quick wins and the sting of fast losses. The other becomes an investor, researching quality companies, making just a few purchases yearly, and mostly ignoring the daily market noise. 20 years later, one has a portfolio worth over $500,000. The other has less than they started with. The shocking truth about which approach builds wealth, and why our brains are wired to choose the losing strategy, is what we're diving into today. Today, I'm breaking down the 5 critical differences between trading and investing. What the professionals don't tell you about each approach, which one fits your personality, and why most people who think they're investors are actually trapped in a trader's mindset without realizing it. If you want to understand which approach is right for you, not what some guru is selling, hit the like button. It helps more people discover this financial clarity. And make sure you stay until the end for our bonus strategy section, where I'll share the hybrid approach that combines the best elements of both worlds, something even the professionals rarely talk about. Here's what most financial content won't tell you about this topic. Most people lose money not because they picked the wrong stocks, but because they're trapped between two worlds, using an investor's toolkit with a trader's psychology. Think about it. Have you ever researched a company thoroughly, bought it as a long-term investment, but then sold in a panic when it dropped 15%? Or maybe you've held onto a losing position far too long because you believe in the company? These contradictions aren't your fault. Most financial education doesn't clearly distinguish between these two entirely different approaches to the market. These 5 differences aren't complicated theory. They're practical distinctions that will immediately clarify which path aligns with your goals, your personality, and your lifestyle. Difference number 1. Time horizon. Days versus decades. The single greatest edge an investor can have is a long-term orientation. The first and most fundamental difference between traders and investors is their relationship with time. Traders operate in what I call the excitement zone, time frames ranging from seconds to months. Day traders might hold positions for just minutes or hours, closing everything out before the market closes. Swing traders might hold for days or weeks, looking to capture short-term price movements. When you watch someone with multiple screens showing charts with colorful lines and indicators, that's the trading world, where minutes matter and quick decisions rule. Investors, by contrast, live in the patience zone, timeframes of years, decades, or even generations. The legendary investor Warren Buffett's favorite holding period is forever. When true investors buy a stock, they're thinking about where the company will be in 5 to 10 years, not where the stock price will be tomorrow. The real-world impact of this difference is enormous. Traders need to be constantly engaged, watching markets, setting alerts, and making quick decisions. The time commitment is intense. Investors can review their portfolios quarterly or even annually with similar results. Think about your own life and schedule. Which approach realistically fits with your daily routine and temperament? Difference number 2. The analysis method. Technical or fundamental? Traders primarily use technical analysis, studying price patterns, volume indicators, and chart formations to predict short-term price movements. They're looking at resistance levels, support zones, moving averages, and momentum indicators. When a trader opens their computer, they're looking at graphs, charts, and technical indicators that help them spot patterns and trends in price movements. They might not even know what the company actually does. Investors, on the other hand, focus on fundamental analysis, studying the actual business behind the stock. They analyze financial statements, competitive advantages, management quality, and industry trends to determine a company's intrinsic value. Investors care about the difference between price and value. They're trying to buy companies for less than they're worth, then hold them as they grow over time. The daily price fluctuations matter far less than the company's long-term trajectory. Ask yourself, do you enjoy digging into business models and financial statements? Or do you prefer the technical patterns of price charts? Your natural interest will likely push you toward one approach or the other. Difference number 3, psychology, adrenaline, and patience. The stock market is a device for transferring money from the hyperactive to the patient, Warren Buffett famously said. Trading is fundamentally a high-stimulation activity. The short time frames, constant decisions, and immediate feedback create an environment similar to gambling. Many traders openly admit they enjoy the rush of making quick profits. This isn't inherently bad. Some people thrive with this kind of stimulation, but it comes with psychological challenges. Studies show that the more frequently people trade, the worse their returns become. The emotional roller coaster of wins and losses leads to impulsive decisions. Investing, by contrast, requires emotional discipline over long periods. The investor's greatest enemy isn't market volatility, it's their own impatience. True investors must be comfortable doing nothing for long stretches while their investments compound. As Charlie Munger says, the first rule of compounding is to never interrupt it unnecessarily. Your own psychological makeup matters enormously here. Are you comfortable with the adrenaline spikes and crashes of trading? Or does the slow, steady path of investing better match your temperament? Difference number 4, capital requirements. Traders often use leverage, borrowed money, to amplify small price movements into meaningful profits. A 0.5% price movement might seem tiny, but with 10 times leverage, that becomes a 5% gain on your capital. This approach can create outsized returns, but also outsized risks. Most traders put considerable money behind individual positions, sometimes borrowing to increase their potential returns. Investors, by contrast, rely on compounding, the eighth wonder of the world, according to Einstein. They let time do the heavy lifting, as their returns generate more returns over decades. A simple example shows the difference. A trader might aim for 1% weekly returns, which is ambitious, resulting in about 65% annual returns if consistent. An investor might achieve 10% annual returns, which doubles money roughly every 7 years. After 30 years, the investor who simply earned market average returns would have 17 times their starting capital through pure compounding. Be honest with yourself. Are you ready for the higher risk, higher reward world of trading? Or does the reliable compounding of investing better align with your financial goals? Difference number 5, competition. Trading puts you in direct competition with professional traders who have enormous advantages. Access to the fastest trading technology, teams of analysts and researchers, algorithms that can execute thousands of trades per second, information advantages through industry connections. It's like deciding to play one-on-one basketball against NBA professionals. Some amateurs might occasionally win, but the odds are heavily stacked against them. Investing, however, doesn't require you to outsmart the professionals. When you invest for the long term, you're essentially partnering with growing businesses and participating in the expansion of the overall economy. As Jack Bogle, founder of Vanguard, put it, "Don't look for the needle in the haystack, just buy the haystack." This difference in competitive dynamics explains why study after study shows that amateur traders consistently underperform the market, while regular investors who simply buy and hold index funds often outperform even professional money managers. Ask yourself, do you truly have an edge that lets you compete with trading professionals? Or would you be better served by the investor's path of riding the market's long-term upward trend? As promised, here's the hybrid approach that combines elements from both worlds, what I call strategic position management. This approach uses an investor's mindset and time frame, but incorporates some tactical elements from the trading world. The first key to strategic position management is building what I call a core and satellite portfolio structure. This means anchoring your financial foundation with 80 to 90% of your money in solid, long-term investments like index funds and established blue-chip companies, while strategically allocating just 10 to 20% toward more tactical, actively managed positions. This foundation gives you stability while still allowing for some calculated risks. Equally important is adopting the trader's discipline of strict position sizing. where you carefully limit how much capital goes into any single investment idea. Think of it as never putting too many eggs in one basket, while maintaining the investor's patient, long-term perspective. You can further enhance your returns by using basic technical analysis to identify strategic entry points for your long-term investments, essentially buying the dips, on companies you already believe in, which potentially improves your overall performance without falling into the trap of frequent trading. To maintain emotional discipline, establish scheduled review periods, perhaps quarterly or semi-annually, rather than checking your portfolio daily, which combines the systematic analytical approach of a trader with the patience and perspective of an investor. Together, these practices create a balanced hybrid approach that preserves the proven advantages of long-term investing while incorporating just enough of the discipline and strategic thinking from the trading world, without subjecting yourself to its high-pressure environment, excessive time demands, or outsized risks. The difference between trading and investing isn't just semantic. It's about aligning your market approach with your personality, goals, and lifestyle. Trading offers excitement and the potential for quick profits, but demands intense focus and acceptance of higher risks. Investing offers reliable growth and peace of mind, but requires patience that many find difficult to maintain in our instant gratification world. Neither is inherently superior. They're different games with different rules and different rewards. If this video helped clarify your path in the financial markets, hit that like button and let me know in the comments whether you lean more toward trading or investing. Remember, the most expensive market mistake isn't picking the wrong stock. It's playing the wrong game for your personality and goals. Don't forget to subscribe and turn on that notification bell to never miss the weekly insights. Always remember, simplify money, Muchafy wealth, one smart decision at a time.